Hello, I'm Hickey from interest.co.nz and welcome to a special housing report brought to you in association with ASB. This one is an amazing chart, we think, and because we love charts here at interest.co.nz, this one shows essentially the steepness of the mortgage rate curve. What does that mean? Well, when you have a steep curve, that means that borrowing short term is much cheaper than borrowing longer term. And it's actually unusual for New Zealand to have a steep curve, a steep upward sliding curve. And you can see here that for most of the early 2000s, it was actually more expensive to borrow short term than it was to borrow long term. And so a lot of people went on to fixed mortgages, particularly longer term fixed mortgages. Well, that has turned around in a big way in the last 4 or 5 months, and certainly through 2009, as interest rates for longer term debt have increased relative to short term. And so that means there's now a bit more of a genuine choice when you're thinking, should I fix or should I float? Floating rates are low. They're certainly lower than 2, 3, 4 and 5 year rates. They're not quite as low as 6 month, 12 month, 18 month rates. But certainly it puts a bit of doubt in your mind. It's an unusual situation. It's actually potentially good news for the New Zealand economy. If more people are on variable rates, it's much easier for the Reserve Bank to move interest rates and move the economy quickly. In Australia, most people are on variable rates. Here, most of us are on fixed rates. We'll see whether this sharp upwardly sloping yield curve actually changed New Zealand's behaviour. We'll see. The banks haven't cut those floating rates very sharply, so that they're right at the bottom of the curve and the lowest rates. But something is happening here, and it's worth watching for the longer term. I'm Hickey. That was a special housing report brought to you in association with ASB.